Hey guys, Rhett here. What's going on? I want to talk today about something I get questions about all the time. And a lot of my coaching clients need this because they're coming into the coaching program with somebody else. Okay. What I want to talk about is partnerships. How do they work? How do you set them up legally? What do you need from a legal standpoint? What do you need from a document, from a paper standpoint, to make sure that partners are equal partners or not equal partners, or share a percentage of the value of the home or the equity of the home or the cash flow. I know that people love to partner up on deals, pool money together. It gives everybody the opportunity to get into property at a cheaper price because, well, the price is the same, but your cash out of pocket can be less because you're going in with one, two, maybe three, four partners. But it's so important, guys, when you set up a partnership to make sure it's done the right way. Now, nobody likes to talk about this, but having partners is difficult in 99% of cases, 95% of cases, because you have to make sure that everything you do is in line with your values, your goals. You might think that somebody in your partnership has the same goals of you as you do, but it turns out they don't. I will say this: I work with a bunch of partnerships in my coaching program. They're all phenomenal, and that's because these people have similar goals. They understand how to get to those goals. They're extremely coachable, and they're very receptive to criticism and information. So when you have two partners that are both very open to new ideas, who have the same goals, who have the same ethics and morals, you tend to be very successful. Now, just like anything else, money is very confusing. It is very, it can create issues amongst people. So if you have the opportunity to go in solo, that's always good, because at any time you can change your mind and change the decision-making process. When you have a partner, it's not that easy. You have to make sure that the partner is on board with any changes that take place. You have to make sure that from an ethical standpoint and a moral standpoint, you're taking on a partner that you share those commonalities with. A lot of times, if you're joining forces with somebody, or you're partnering with somebody you haven't done business before, you can find that out the hard way. Okay. Now, with that being said, partners that I've had in the past have been phenomenal. So there are instances where you can have partners that you stay with for a very long time. However, a lot of partnerships don't end well. Okay. Now, what do we do from a structural standpoint to set ourselves up to make sure that our assets, our money is protected when we get into a partnership? Okay, so the first thing when you're finding a partner is you have to find somebody that you trust, number one. If you've done business with them in the past, that is also phenomenal, because you understand how they do business. You understand if they're patient. Patience is an incredibly important aspect of any partnership. And of course, your relationship. You want to make sure that you guys get along, or you ladies get along, whatever it is. You need to make sure that you communicate well with each other. Communication is extremely important. Honesty is extremely important, okay? When you guys are talking about partnerships, you're talking about spending a lot of money, right? More money than you might have personally. So you're bringing somebody in that has more money than you, the same amount of money as you. You're putting up equal money. Or maybe you have a partnership and someone else is putting up all the money, but you're running the whole show. You're managing it, okay? I get a lot of questions all the time on what should the splits be. So, for example, if I'm going into a partnership with somebody, how much should they get? Whether it's of cash flow, whether it's of equity, what should they get? And guys, when it comes to partnerships, and a lot of people don't like to hear this, but the most important aspect of a partnership, as far as who gets more equity, who gets more value, it's the person that puts up the most money, okay? Now, what does that mean? Well, if two people come into a situation and they both say the investment's $100,000, they both come in with $50,000, obviously that's easy. They'll be 50-50 partners. Now, for example, say you want to raise money and you want to get into Section 8 real estate investing, or you want to buy a long-term hold property, but you don't have any money. You go to somebody and you say, listen, you put the money up, I'll run the whole thing. I'll take care of everything. You won't have to worry about a thing. In those cases, the person that puts up the money still receives at least 50% of all the equity and all the cash flow, okay? Now, personally, I think that's a great deal. So someone basically puts up all the money as a silent partner. You, who've been watching the channel, you learn how to do this. You guys are the ones that are running the whole show, okay? So you say, I'll take 50% and I'll run everything. You don't have to worry about anything. Now, you're doing all the hard work, but that person that puts up the money still gets 50%, right? So that is usually how partnerships are structured, right? The person that puts the money up takes at least 50% always, okay? So again, you're not putting anything up, you're doing all the hard work, but still, you're still getting 50% for really no skin in the game. Now, of course, every partnership is different. There's no standard rules as to, what the splits need to be based on money. You could have a silent investor that says, listen, I only want 30, 40%. I only want 25%. You take 75%. You run the whole show. Not as common, but possible. Anything's possible, okay? Now, let's talk about setting up a partnership from a legal standpoint. And this is extremely, extremely important. You guys hear on the channel all the time that I like to always, no matter what we're starting, okay, whether it's a property investment, whether it's a partnership, it doesn't matter. Everything that we get into as investors and as intelligent human beings, we always have to begin with the end in mind, okay? You have to begin with a bad ending in mind, and you begin with a good ending in mind, okay? One of the ways that we always protect our liability and cover our exposure in case something goes wrong, which we always plan for. You always plan for the worst case scenario, right? We hope for the best, plan for the worst, always. So if that worst case does happen, we're prepared for it, right? And if the best case happens, we're super happy. Anything in between is fine. So you need to make sure that you plan for a disaster always. So what's a disaster in a partnership? Well, one partner says, you know what? I don't like you anymore. I don't like this investment anymore. I want my money back. I want to leave, right? That's a bad case scenario. So how do we structure to make sure that if that happens, if that day comes, we're protected? And the best thing to do, guys, when you're doing a partnership is have an operating agreement. Okay, an operating agreement will outline in paper. It's a legal document signed by both partners or three partners or whatever it is, outlining the ownership percentages, the payout percentages, who gets what, who gets equity, who gets cash flow, how long the deal is good for, when it expires, if there are any changes that will happen over the next couple years, where the equity goes, right? Everything, every aspect needs to be detailed and written down on a legal document, okay? Now, guys, for a couple $100, you can have a lawyer write this up in whatever state you're investing in or whatever state you're from. So if you and a friend both live in Colorado or you and a friend both live in Florida and you want to have this document written up, get in touch with a lawyer in your home state. It'll cost a couple $100, and they'll write up a legal document based on exactly what you want. Whatever you and your partner decide of, hey, these are the splits, this is what I get, this is what you get, you guys take that to an attorney, have that written up, okay? Now, when it comes to stuff like this, guys, you can always do the legal Zoom, you can always do the online route, but it's always better to get things done with an attorney in your home state, someone you can get on the phone with, you can talk to, you explain the intricacies of whatever partnership you're planning on getting into, okay? So that's extremely important. Now, once you have that done, you're ready to begin. Now, some people, what they'll do is they'll start an LLC. When you start an LLC and you have two partners or three partners, what you'll do is you'll give each partner a 50% equity share in the LLC or a 33% equity split in the LLC. And then again, if the partnership ends up dispersing, there's a couple different ways you can do it. It can get a little hairy. You'll have to end up buying people out of their equity. They'll have to sell their shares in the company. There's a couple different ways to do that, but I'm not going to get into that because there's a million different ways that you can have somebody leave the LLC. It can get a little bit strange. You got to buy them out. You got to take that to the filing of the state the LLC was made in. You have to update the LLC. That way they have no more tax liability for the LLC. There's a bunch of different ways. We're not going to discuss that in depth because there are a ton of ways to modify LLCs, change LLCs. If you're planning on going into this with an LLC, just know that when you create the LLC, you can do whatever split you want as far as equity goes, and that can change. You can change that. You just have to make sure you file that with the state to keep them in the loop, right? Because LLCs are living entities, and they are documented at all times with the state that the LLC is created in. So you have to keep that up to date too, okay? So guys, that's just a little bit about structuring partnerships. My main advice to you when doing so is make sure that you and whoever you're getting into this with have a clear, concise idea of what you want to do. What you want to do, make sure you guys have the same goals, and make sure that before you actually spend one penny, you have an operating agreement in writing, signed by both parties. Both parties have a copy of that agreement, and that's done by an attorney, okay? You just want to always have that for your records. Hopefully you never have to go back to it, but it's good to have in case that bad day does come. You guys have something to fall back on and have something to refer to. That way it's not ugly when it comes to, hey, we have to sell this, we got to sell this. Well, I want this. Well, no, I want this. I want this. That's not what you want. It's how friendships are ruined, and that's how partnerships are destroyed. So, guys, get the operating agreements taken care of. Structure everything in paper, structure in writing, structure it all legally. That way there's no questions if things go bad. Okay, guys, thanks for watching. Leave your questions and comments below. I'll get to all of them, and we'll see you next time.